What's going on, guys? This is Lucas from the Early Retirement Club here. This is the digital extension of our club. And in this video, I'm going to show you 3 steps to achieve a successful and comfortable early retirement. Everyone can achieve comfortable early retirement. Well, reasonably early. We are not here to teach you how to retire by age 30, we do not know how to do that ourselves. But through our personal journey and the journeys of plenty of other people around us, we know how to do it with 15 years of work or shorter. You do not need to be lucky and bought Amazon stock in 2010. You do not need to eat carrots only for 15 years. All you need is a disciplined investment approach. Like many other big ideas in life, just like going to the gyms twice every week, the idea is simple and we know it works, but it is not necessarily easy to do year after year. This video therefore will share the 3 key steps we developed to make it easier to stay disciplined. And let's get started. First step, build some patience before you even start building your portfolio. You do not need an endless amount of patience, but you do need some. Investing is a place where people who have patience trade their patience for money. And people who do not have patience free than one for patience. The conversation between the 2 richest men on earth best illustrated these dynamics. Jeff Bezos once asked Warren Buffett, "You're the second richest guy in the world. Your investment thesis is so simple. Why does not everyone just copy you and get rich too?" To which Buffett replied, "Because nobody wants to get rich slow." So here it is, the first step is to build some patience before you even start building your portfolio. Everyone investor was told that diversification is the key. And you need to build a retirement portfolio that fits your risk profile by diversification. However, whatever your risk level is, it is a big risk in itself. A key lesson I've learned is that at any stage in life, you need 2 portfolios. One for the long term, in case you live to 120 years old. And another one for the short term, in case you need to visit the emergency room next month. This is diversification at a grand level. It is diversification at a life scale before you diverse at finer scales such as holding different stocks, bonds, et al. And in the next step, we will see how to build these 2 portfolios. Whatever your risk level is, build one portfolio below it and one above it. The portfolio below it is more conservative than what your comfortable risk level is. It is for short-term survival as aforementioned. The portfolio above it is more aggressive than that your comfortable risk level is, and it is for long-term survival. This is diversification at a grand scale. At life scale. At this point I do want to give you heads up, that the next part of this video is going to be a bit more in depth and also a bit more technical. This is also going to the overall style of my channel. And this will be the niche of our channel. There are already wonderful channels available to help people with the basics of investing, the 101 of the stock market, and basic retirement planning. Therefore, we would not repeat those basics here anymore. Our niche will be to provide more in-depth analysis and more directly useful skills that you can use in practice. As a result, this channel will be most valuable for 2 types of investors. First, beginners who already understand the basics and want to learn more, achieve more, and also grow their money more. Second are more advanced investors with quite a bit of investing and financial skills already. This will be placed to have in-depth discussions and we help each critic and dissect our ideas. After all, a disciplined investment approach is like many other big ideas in life, the idea is simple and we know it works. But it is not necessarily easy to do year after year. It is just like going to the gyms twice every week. Therefore, last and not least, this is a place that we build a community for people to support vet each other's ideas, and keep learning from other. With this background, we will share two proprietary model portfolios. 2 models that we've perfected and vetted with our own money. The conservative portfolio is a variation of Ray Dalio's all-weather portfolio. I have developed it solve our short-term survival problem. And it did its job. It helped us avoid disastrous crashes and accomplished capital preservation wonderfully through the years. It is not a paper portfolio for theoretical discussion. We have been using it for years ourselves, and a major part of our family funds are invested in it. For readers who would like to follow this method in real time, we will keep providing regular updates of my portfolio composition and provide commentaries. We typically update this portfolio on a bi-monthly basis unless there is a major market event like the sell-off during the 2020 pandemic. The portfolio consists of: first, about 10% cash or cash equivalents such as short-term treasury bond. The level of cash is dynamically adjusted based on the valuation of the stock and bond market. It can go to 0% when the market is undervalued, like during the 2020 pandemic turmoil. We will provide details of the adjustment method in future videos. Second, 10% gold and silver using a gold-silver trade strategy. Third, 15% intermediate-term treasury bonds. Fourth, 15% long-term bonds, treasury bonds. And finally, the remaining are invested in stocks with equal exposure to U.S. large cap, U.S. small cap, international stocks, and real estate stocks. This chart shows the performance of the conservative model portfolio over a longer period of time. The performance of the conservative portfolio is shown by the blue line since 1994. And the performance of the overall market, the S&P 500 index, is shown by the red line. Overall, as you can see, the method does an excellent job preserving capital. And at the same time, the conservative portfolio also kept handsome growth, although the growth lags the overall market in general. For one thing, the sizable cash holding creates a drag by itself. But remember, growth is not the goal of this portfolio to start with. Its goals is to not fluctuates too much. So it provides the cushion funds we need whenever we need it. As seen, it indeed fluctuated a lot less and does a much better job preserving capital than the overall market. The preservation capabilities are even more impressive when we look at the historical drawdowns during all the market crises. In the past 3 decades or so since 1994, there have been 4 major market crises. As highlighted in the orange box, the overall U.S. market suffered drawdowns of 50%, 44%, 15%, and 5% respectively. In contrast, the conservative portfolio only suffered one double-digit drawdown of 26%. And all the other drawdowns are in the single-digit range, from 2% to 8%. So again, it does what it is supposed to do. It provides the cushion funds we need whenever we need it, so that we do not have to sell our assets at fire sale prices when we need funds. As wonderful as the conservative portfolio can be, it has issues for the long term. As its growth keeps lagging the market, eventually we will not have enough money in the long term. And this is where the long-term portfolio kicks in. The goal of the long-term portfolio is to provide the growth, and we do not mind too much price volatility here, because we will not sell assets from this portfolio anytime soon. As you can see, the long-term portfolio uses overall stock funds such as VTI. It also uses specificity fund like the biotechnology funds, XBI, to grow more aggressively. It also includes more individual stocks we picked for their long-term return potential. And furthermore, the portfolio also applies a leverage to the stock holdings. For example, we hold the ProShares Ultra Pro QQQ, TQQQ, fund. It is a leverage fund that provides 3 times leveraged exposure on a daily basis to NASDAQ 100 index. So if the NASDAQ 100 index goes up 1% today, it will go up 3%. And vice versa, when NASDAQ 100 goes down 1%, it goes down 3%. But betting on the longer-term bullish trend of the overall market and U.S. economy, Such more aggressive exposures provides favorable odds to beat the market in the long term. This chart shows the performance of the aggressive model portfolio over a longer period of time. The performance of the aggressive portfolio is shown by the blue line since 1994. And the performance of the overall market, the S&P 500 index, is shown by the red line. As seen, the performance is compared during a 15-year period, from 2006 to 2020. And the aggressive portfolio outperformed the S&P 500 index most of the time. It really took off and began to dominate the S&P 500 index shortly after the 2008 Great Crash was over. In terms of dollar amounts, the aggressive portfolio outperformed the overall market almost by more than 200% in the past 15 years. For $10,000 invested in the overall market, it has grown to $30,000, not that bad. However, our aggressive portfolio has growth more than six-fold, to almost $65,000. Truly impressive. Again, this portfolio is our real portfolio. And we adjusted it monthly. The returns included dividend reinvest. We will update it and discuss more details, such as how we use the leverage in a disciplined way, in our future videos. This video is getting long enough at this point. And we will wrap and see you next time. To summarize and recap, the 3 key steps to achieve financial security for a comfortable early retirement are: Step 1. Build some patience. Investing is where people trade patience for money, and vice versa. Step 2. Do not build one perfect portfolio. It creates a big risk by itself. Step 3. Build 2 portfolios. One for long-term survival and one for short-term. It is diversification at a life scale. THX for watching and see you next time.